Good evening, students.
We will wait for 5 minutes so others can join and then we will start. So while joining, please add your roll number first. Kaushal Rodke, write 2024 26 and then your roll number. Please rename yourself Kaushal. Am I audible to everyone? Can anyone give me the confirmation?
Yes, sir.
Thank you. Is my screen is visible to you guys?
Yes, sir.
Okay, thank you. Okay, so we'll start. In this session, in the evening session, we study the subjects that is financial reporting. Okay. So in financial reporting, we understand the different, we can say the financial reporting aspects. Okay. The purpose and scope of the financial statements. We understand the, we can say the going concern, consistency, accrual basis systems. Then we understand, we can say the preparation of the corporate financial statements, and we can say what are the different rules and what are the different bodies, we can say, who make the rules and regulations for this financial reporting. Okay, we see the, we can say, Companies Amendment Act, 2015. Okay, we see the different financial statements we prepare, that is balance sheets, income statement, cash flow statements, and changes in the equity. Okay, we also see the, we can see the preparation of items in financial statements, and revenue recognition using the relevant India, we can say the Indian accounting standards, that is AS. Okay, so all that part we covered in these subjects. Okay, the first chapter of subject is financial statements preparation framework. Okay, so that part we covered in these sessions. Okay, in that part, we can say first we understand what are the financial statements. Okay, already you guys understands the financial statements in your first semester, in the subjects of, I think, managerial accounting. It is right. You guys understands what is the balance sheet. You guys understand what is the income statements. You guys understand, we can say, cash flow statements, and I think the fund flow statements also. Is it right? Are you guys prepared these statements? Yes or no?
Yes, sir.
Guys, yes, I want your answers. For what purpose? So I can know that you are actively participate in the sessions. Okay, I don't want you just join the sessions and keep your mobiles on the tables and do your own stuffs and works. Okay, so please be aware and be present with your body and mind in the sessions, so we'll understand what I'm telling to you guys. Okay, so financial statements are actually, we can say, the structure representation of the financial data. Okay, we extract the data from the accounting and we made the financial statements. Okay, in accounting, what we did, we can say, we make the entry of every financial transactions, what we are paying, what we are receiving. Okay, we can say in book, okay, in bookkeeping we made the every entry, okay, at the exit level and at the in level. Okay, so all the financial transactions we have with us according to a date for any financial year. Okay, what we do then, okay, first we do the entry in the books. From that we made the ledger. Okay, we made the ledger. Okay, then we can say we closing and opening balance, that we made the arrangements. Okay, then we get the trial balance. Okay, and then we get on that trial balance basis, we made the different financial statements, that is the balance sheets. In balance sheets we know the all the assets on the one side of the statements and all the liabilities on the other sides of this of the statements. That shows me the what is the exact financial position of any organizations. Okay, is the financial position of the organization is good or not. Okay, if the assets are greater than liabilities, then we know the financial position of the organization is good. If the liabilities are greater as compared to assets, then the financial position of the organization is not good. So what we conclude from the financial statements, same with the income statements, that is what we also say, that that is the profit and loss statements. Okay, on the basis of profit and loss statements, what we conclude is the company is making profit or the company is making a losses. Okay, so in these subjects we are not going to prepare these statements. Already you guys study this all these statements in your first year in the subjects of managerial accounting. In these subjects we only understands what are the different rules, what are the different standards given by the national or the international bodies. Okay, same we can say we can say in India, that is the Institute of Chartered Accountants of India, or the governments issued the rule for the accounting standards. Okay, so we in these subjects we only understand what are the different rules and what are the different standards for the accounting. Okay, for the financial reportings that we are going to study in these subjects. Okay, what are the different standards we use while the preparation of these financial statements, that we are going to study in the subjects name, that is financial reporting. Okay, so what is the purpose of the financial statements, that recently we discussed that why the preparation of the financial statement is much needed. Okay, while doing the business. Okay, so first we can say the first purpose is the provide the structured informations. Okay, uh, when we are able to calculate the any organization is making a profit or loss when we have all the transactions with us. Okay, with that transactions we made the profit and loss account, and then we conclude that the organization is in a profit or is in a loss. Okay, if the organization is in a loss, then an organization has to take some steps to, we can say, to reduce the losses, or to, or we can say to uh, overcome the losses and start generating a profit. Okay, then and then only the companies can take the actions on the basis of the results they found in the financial statements. Okay, so the financial statements gives us the structured informations. Okay, the financial statements we can say the gives the relevant information about an entity's financial positions, the performance of the organizations, and changes in the resources. Like we can say the changes in the equities that we found while working in the organization. So all that we can say information provide us by the financial statements. Okay. Now next purpose is the financial statement supports the top management, the managers. We can say the owners of the organizations to take any certain decisions. Okay, on that basis, the results they are looking at the financial statements. On that basis, they take a certain decisions. Okay, if they find that the organization is doing a very well, they generating a very good profit, then what they do, they think of the expansion. Okay, if they are generating the good profit in the Maharashtra, then maybe the owner thinks that they can expand their business in the other states of the India. Okay, so say like such a decisions were taken by the owners or the top management of the organizations on the basis of the data provided by the financial statements. Okay, now next one is we can say the reflect the financial reality. The financial statements shows us the what is the current financial position, what is the financial reality of the organizations. Okay, if they are making profit or losses, if they are having the enough working capital with them or not. Okay, if they are we can say making, we can say they are in a growth stage or not in that growth stage what the owner wants from the organizations and from the business. Okay, so all these financial realities shown by the financial statements. So these are the purposes. For that purposes, we prepare the financial statements. Okay, so these are the four financial statements you guys actually learned in your first year. That is the in the subjects of managerial accounting. That is the balance sheet shows you the assets and liabilities and equities at the specific point of time. Okay, you actually prepare this in the we can say the upcoming sites. I'll show you the balance sheets. Then you will recall the concepts of the balance sheets. Next one is the income statement. In income statements, what we actually do, how much revenues the any organization receives, what are their different expenses, what are we can say what are their other administrative and the selling expenses, and what are the interest and taxes they are paying. Okay, and after we can say minus all these expenses, all these things, they get the net income. Okay, so we calculate, we can say the net profit or the net income in the income statements. The what they left with the organization after we can say minus all these expenses or the taxes and the interest that they have to pay, the financial obligations they have. Okay, in the income statement, we are not doing that part. In cash flow statements, we track the cash movement record because, as we know, for any business organizations, the cash and the liquidity is very important aspects you learned in the subjects. I think in financial management, that is the working capital. So, working capital is the liquidity or the cash required to keep the organization in a running state. Okay, so cash flow moments that is in the operating stage, in investing and the financial activities, the cash we can say is available or not. If the cash is not available, then process is not running smooth. So that part we understand in the cash flow statements. In changes, we can say in equity statements, we understand the is the wealth of the owners, that is the stakeholders or the shareholders, is increases day by day or decreases day by day. Okay, that we prepared the statements, that is the changes in equity. Okay, so what we accept from the statements of the changes in equity, what we wha- any owner or any shareholder wants, he wants the increase in his equity, he wants the we can say the wealth maximizations from the business. Okay, so all these statements you guys understand in your first year. So here is the balance sheet example I have taken from you guys. What you find on the left hand side, there is assets. Okay, so in assets there are the two parts, that is the current assets we show on upper hand, and there is a non-current assets. So what is mean by current assets? And now all you guys know that the assets you receive within a year or within a 365 days, the amount of money you receive, or you can convert that assets into the cash, into the liquidity. That assets we called it as the current assets. And the non-current assets, that is you cannot convert that assets into the cash or into the liquidity within 365 days, that is the non-current asset. That means the land, buildings, equipment, okay, depreciations, all these are the non-current assets. So in liability part, that is you also have the current liabilities and non-current liabilities. Okay, so the financial obligations you have within a year, within 365 days, you must have to pay this amount of money to your creditors. That we called it as the current liabilities. Okay, so below you see the non-current liabilities. Okay, so balance sheet shows you actually the financial position of the organization. So for that balance sheet preparations, what accounting standards we use. Okay, so that we are going to study in the subjects from the chapter from the second chapter onward the second chapters. We are going to study this part, that is the water rules and regulations and the standards we use. Now next is we can say the income statements example. If you see in income statements, there is we can say the income statement prepared for one company, that is the Teddy Fab company, that is the year ended December 31st, 21,000. That is just an example. So the company generated the revenue of near about the 10 lakh. Okay. So they have the cost on the 10 lakh is the 2 lakhs and their gross profit is 8 lakh rupees. Okay. After X, we can say the minus all the operating expenses, they get the operating income of the 4 lakhs, near about 4 lakh 17,100. And after paying the interest and all the taxes, they get the net income of the 1 lakh 97,000. Okay. So what the standards we use to prepare these income statements that we are going to study in the subjects. Okay, this is the cash flow statements for the we all know the organizations have the different departments. So it is the operations department, okay, financing. Okay, so all these cash flow statements, cash how cash flows in the organizations that we are show in the cash flow statements. So what are the we can say the different standards we use? Okay, we are going to study in these subjects. Okay, so this is the example of we can say the changes in the owner's equity. If you guys see, so here is the one company and the company's we can say owner's equity on January 1, 2022 is the 500. So it's just example, that is they show the 500 is in a dollars. Okay, so owner, that means the owner's equity, that means the owner wealth in the company is $500. Okay, so his additional capital contribution is 300, his net income is 75. So that shows we can say his increase in equity. So his net income is 375 and his actually he already invested the 500 amount, so now the total is 875. Now let's withdraw. He withdraw the $1,500 from the organizations for his personal expenses. Okay. So whenever he withdraws the equity for his personal expenses, automatically his equity gets decreases. Okay. So the owner's equity at December 31st, 2022 is 860. That means we are what we analyze that the owner's equity gets increased by $360 within a year. Okay, so in next example, if you say there is a one partnership firm, if there are two partners, partner A and partner B, how their equity gets change. Okay, so we all this the all that we analyze the in the statements. The name of the statement is changes in the equity. Okay, so in that statements, it is the we can say the same statements, but actually we analyze what change in a partner's A equity and what change happened in a partner's B equity. Okay, so that you guys already learned in the subject managerial accounting. So I just show you the brief. That is the partner A has the 2000 equity and partner B is having the 15,000. Their additional contribution, they made additional contribution in the same year. Partner A contributes the 300 and partner B contributes the 750. So the net income is already show that is the partner for partner A is 72 and partner B 48, and they withdraw the same amount, that is the $20. Okay, so their equity after the 1 year is, we can say, partner A equity increases by the 352 and partners B is the 278. So same likewise, these are the four financial statements that shows you the financial position, the earning ability of the organizations, their cash flows within the organizations, and the equity changes in the organization for the certain period of time. Okay, so while making these financial statements, what are the different rules? What are the different AS, what we call as accounting standards? Okay, so AS, what we are using, what are the international norms, what are the national norms? Okay, uh, what are the norms we can say used in the US, that is the United States? Okay, what are the norms used in the other countries? Okay, and what are the norms used in Indian standards? That we are going to study in these subjects. Okay, so the in these subjects we can say you will only understand what the previous arrangements you guys have done in the different financial statements. Now you understand what we did that arrangement. Okay, because that arrangement we made according to any internet, we can say accounting standards. Okay, so now in these subjects you understand the different arrangements, different adjustments. So why we did this arrangement or adjustment in the accounting. So that we are going to study in this subject, that is financial reporting. Okay. So after we can say the preparation of the financial statements. Okay. Who uses the statements? Okay. So first one is why we why we understand this? Who uses the financial statements? Because financial statements is very important aspects of every business, because we can say the different decisions are depends upon the financial statements. So these are the stakeholders who take the different decisions. Investor takes his investment decision based upon the financial statements. The management takes the different decisions. We can say their investment decisions, their expansion decisions, merger and acquisition decisions. These are the different decisions are taken by the management. Employees also takes the decision based upon the financial statements. If the company is making the losses, then employees think of, we can say uh, left uh, of the organization. So he's thinking that the he can try the another organization who is making the good profit, good revenue. Okay, so these are the different stakeholders who take the different decision based upon the financial statements. So uh, these are the persons who use the financial statements. So first one is the investors. So investors who actually invest his hard-earned money in the organizations, okay, to expand the business or to have the liquidity in the organizations. So what investor wants, any investors are doing the investment, he wants the good return on his investments. He want the minimum risk. Okay, so what he analyze the return potential. If the company is doing making a good revenue, good profit, they are having a good working capital, they are having a good cash flows, increase in their equity. Okay, so so automatically investors get attracted to that organizations for the investment purpose. So investors analyze the financial statements, and he also analyze the management effectiveness and his investment for his investment. Okay, so risks for his investment he also analyze. Now next one is, that is the creditors and lenders. Okay, so some of the suppliers who supplies the raw material to the organization, so these are the creditors. So they also analyze the financial statements. If the company is constantly is in a loss, they stops the supply of the raw material to that organizations, because now they know their payment may stucks in some period of time. Because if the company is in a continuous loss, okay, they will not have the enough working capital, enough liquidity, enough cash with them to pay, to make their payment. Okay, if the company is doing the great, they are generating the good revenue, good profit, then the creditors continuously supply the raw materials to them, because they know they will receive their payments on time. So these are the decisions taken by the investors and creditors. Next one is management. Also, though management also takes the decision based upon the financial statements. If the company is, we can say, generating the good revenue, good profit, they think of the expansion. If the company is, we can say, already is in a loss, so they are not thinking of the expansion of the organization. So they think of only to, we can say, reduce the losses and make the profit. Okay. Now next one is regulators. So we all know that while doing the businessmen have to fulfill some compliance, some laws, some regulations. The bodies like the Companies Act, the bodies like the SEBIs have all the overviews on the companies. So the we can say the bodies like SEBI, the bodies like different regulators who analyze the financial statements of the organizations, if they are showing the fake profit, fake revenue or not. Okay, the some of the companies shows the, we can say, the fake numbers in their financial statements to attract the investors. Okay, so to overview all these things, regulators continuously overview the different financial statements of the organization to reduce the fraud in the business, to, we can say, reduce the fraud with the investors. Okay, next one is employee. We I already told you, we already discussed that the employee wants the good organizations. The company is in a growth stage. The company is making good profit. The company is, we can say, generating the good revenue. They are having the maximum sales. They are having the maximum share market. We can say market share. Okay. So then and then employee want to retain in the organizations. Okay. So, and some of the other stakeholders also analyze the financial statements of the organizations, like the customers, suppliers, and the communities. Okay. So all these are the stakeholder who takes the decision based upon the financial statements, and that's why they uses the financial statements. So the finance, that's why the financial statement should be a authenticated document, so that no one can take the wrong decision based upon that, we can say, the reports of the financial statements. If the financial statement itself, or we can say, it is a fraud, it is a wrong, there are, we can say, the wrongly placed values, okay, the manipulative values are present in the financial statements. Okay, so it may, we can say, any of the stakeholders may take the wrong decisions. Okay, now next one is you we can say, the now next part is the users information needs. The financial statements, what they are giving the informations. Okay, for what, we can say, the meaningful analysis to take the decisions. Okay, they also use the, we can say, the information to clear presentation. Okay, all this information we are getting from the financial statements. Now we also know, if you see in the picture, that the every building construct with the same process. First, what we do, we made the foundations, and on that foundation, every building constructed. Same likewise, we can say, the core assumption, core principles of the financial statements are same. Okay, on that basis, the financial statements are constructed. Okay, so what are that different accounting rules, regulations, and accounting standards? What are those that we are going to study in the upcoming in chapter 2, chapter 3, chapter 4? We have all these different AS, okay, accounting standards number. We understand all these things. Okay, if we follow these rules, these regulations, then and then only our financial statements are good. Okay, if we skip the process of the foundation of the is building we found in the future is a weak. Okay, if you do not follow that rules, regulations, and the standards which are we can say formulated by the different bodies, then your financial statements are not, we can say, that much a strong document. Okay. So while formulating the financial reporting, while doing the financial reporting, there are the three fundamental assumptions that you actually, I think you guys are actually learn the concept, that is the going concern, consistency, and accrual basis. Okay, so what is these things? First of all, we are going to understand what is the going concern. Actually, a going concern is a concept we can say in accounting that tells us that business will continue, okay, continue for over a period of time. Okay, that means what the going concern tells business is we can say a ongoing activity. Okay, so going concern refer the assumption that business will remain operational, we can say for at least the 12 months or above that. ओके, ऐसा नहीं है कि एक महीने में ही बिजनेस, ऐसा हम अकाउंटिंग में दैट वी आर नॉट कंसिडर्ड इन अ बिजनेस. ओके, so that is actually the going concern, that we assume that the business is the going activity, the ongoing activity, continuous activity. Okay, so that's why the we can say we value the assets on the historical value or the fair value, not on the liquidation value. लिक्विडेशन वैल्यू दैट मीन्स कि ऐसा नहीं है कि हम अभी किसी भी एसेट्स का वैल्यूएशन करते हैं तो जिस द वैल्यू द प्राइस ऑन विच दैट वी परचेज दैट, ऑन दैट वैल्यू वी कैन से वैल्यू द एसेट्स, नॉट कि या अभी हमको इसको बेचना है, दैट वी आर क्लोजिंग द ऑर्गेनाइजेशन. ओके, वी आर liquidating the organizations. Okay, that we do not assume. Okay, so that is the going concern. Okay. Now, next one is the, we can say the consistency assumptions. That in consistency assumptions, that means whenever you use the one type of the accounting standards, okay, you must use that accounting standards. That means we can say the accounting methods and principle consistently from one period to the next. Okay, so that means if you use the same principles and methods, that ensures the financial statements are comparable over a period of time. Okay, then and then only. If you use the different principles and different methods, then you cannot, we can say, compare the different financial statements over the period of time. If I want to, we can say, compare the data of the last 15 or the 20 years, but I use the different methods and principles, so it is not comparable. But if you use the one type of methods and principle to make the financial statements, and then you can easily compare the financial statements over the period of time. Okay, so consistency is must required while we can say while the preparation of the different financial statements. Okay, and why we can say what is the purpose of the consistency, that we can say what we written over here, that is, they enable the meaningful comparison of an entity's financial position and performance over the period of time. That actually I told you now, and we can say revealing generally trends rather than accounting included changes. Okay, so you must, we can say, consistently use the same rules, same methods over a period of time, and then only You can compare the things. Okay. So this is the one concept. Now next one is we can say the accrual basis assumptions. So what is mean by the accrual basis assumption? Accrual basis assumption. For example, we there are different transactions going on while doing a business. Okay, we continuously paying the amounts, we continuously receiving the amounts. Okay, this some of the times we sells goods, but at the same time we are not receiving the payment, but after 1 month we are receiving the payment. But when we consider that the transaction is happened at the time of selling of the goods, that is the accrual system. That means accrual assumption, we can say the state that the financial transactions, we can say, are recorded when we we can say the financial transactions when they occur, then we can say we made the we can say the final entry of the transaction in a book. Okay, we receive the payment after the 1 month, because we can say there is a lack of 1 month while receiving the payment, but we made the entry on the same date. Okay, that is actually the accrual basis. That is the accrual basis assumption. Okay, that means if you read that the revenue organ recognize when earn, here are some of the examples are given. The revenue recognize when earn, not when the payment received. That means when you sell something, okay, you recognize the earning now, but you get the payments after the 1 month. Okay. Next one is expenses recognized when incurred but not paid. Okay. Sometimes we require the raw material for, we can say, for the production purpose. What we do, we order the raw material that we require to the suppliers. Then supplier sends the material, but we don't have the enough cash with us. We are not in a position to make the payments. Okay, so we quickly we not made the payment, but we receive the raw material. Now that means the expenses recognize. Okay, but we not instantly we made the payment. We made the payment after the 2 months. Okay, but what we are do, we in accrual basis assumption, we consider that expenses on the same time that the expenses are, we can say, incurred. Okay, so this is the accrual basis assumptions in the accounting. And now there are the different financial accounting reporting framework. Now we are going to study that part. If we you already study in the subjects, okay, managerial accounting. So what is gap? This is one of the accounting, we can say, accounting standards, accounting reporting standards. That is the generally accepted accounting principles. Okay, so these principles is actually primarily used in the United States. Okay, so financial accounting standard boards is a board who made the rule for these systems. Okay, but we in India, we actually we use what we use in India, that is the IFRS and the rules and regulations made by the Institute of Chartered Accountants of India, that is the ICAI. Okay, so international financial reporting standards used in 140 plus countries. We find the numbers over here in a PPT. Okay, so principle based approach uh, that we find in the IFRS. Okay, so these are, we can say, the two major accounting standards we found on the international levels. Okay, uh, now that is the next part. That is the key, we can say, key features or the characteristic of the good financial reporting. Uh, to what reporting, or if you have any financial report, to whom we called it as a good financial reporting. Okay, so some of the we can say the key features. On that basis, if we find that key features in that financial report, then and then only we considered it as the we can say a good financial report. That is, first one is the transparency. Okay, if the report is we can say a very transparent, okay, so everyone shows very clearly, okay, very precisely, okay, so there is a no hidden or the misguided informations in the report, okay, then and then only we called it as that that it is the good financial report. Okay, so the report provide us the true and fair representation of financial position and performance of the organizations. You guys heard many a times there are fake companies or the fake organizations, we can say, register themselves with the government. We in the Companies Act, and they publish the fake financial statements, and on that basis, they we can say they issue a share actually in the NSE or BSE, and they raise the funds from the investors, and they after that they made the fraud with the investors. So some of the things happened in the history. So but the actually the investors must have, if they have the we can say the good knowledge of the financial reporting, okay, so they can quickly understand that report may be a fake. So the transparency is the main important aspects in the financial reporting. Now next one is the, we can say the understandability. Okay, so avoid the complexity in the financial reporting. The report should be a we can say easily understandable to anyone. Okay, so the we can say the report should be, we can say the information in the reports is clearly we can say clearly stated in the financial statements with the reasonable knowledge and the business and the accountings. Okay, so then and then only we called it as good financial reporting. Now next one is we can say the comprehensiveness. That is all the data must covered. Okay, the report should be a comprehensive. Okay, so then and then only we called it as the good financial reporting. Now next one is the consistency. So applying all the accounting principles, we can say uniformly across a period, and we can say the similar transactions. Okay, if we found the consistency in the financial reporting over a period of time, the company is using the same rules, regulations, and the standards while making their financial statements, then and then only we called it as the good financial reporting of the organization. Okay, so already you guys understand the components of the financial statement. So there are the four main components of the financial statements. That is balance sheets, who shows us the financial positions. That is liquidity and liquidity, not liquidity, assets and liabilities. You can say financial position of any organizations. Now income statement shows us the revenue, expenses, and profit or loss situation of the organization. The cash flow statement shows us the cash movements in the organization, and the we can say the changes in the equity statements shows us the uh, we can say the movement in the owner's equity. Okay, if it is a upward movement, then it is good for the shareholders or the owners of the organization. If it is a downward, then it is we can say not good for the owners or shareholders of the organizations. Now, what are the different challenges we can say we find it out while we can say the financial statements preparation. So, what are the challenges any accountant or the financial expert facing we can say while the preparation of the financial statements? That is the involving standards. So, there are we can say different financial statements or the different accounting principles and the rules regulations, we can say continuously we can say the improvement and the changes are going on. Okay, So the accountants and the financial expert must be aware of these changes. Then and then only he can, we can say, made the appropriate report. Okay. Here is the one example given, that the in example given, that is the implementation of IFRS 16, that is the lease. If you are take any property on lease for your business, okay, okay, so previously it is not included in the financial statements. But as per the IFRS 16 shows that if you take any property on a lease, okay, so you must have to show that the payment you made to take the property on a lease, that must be shown in the uh, liability side of your balance sheet. Okay. So the companies who are taking, we can say, the huge acres of lands on the leases, okay, big factories on a leases, they have to make the billions and trillions of payments to the owner of the property. Okay. So that reflects the huge amounts in their balance sheets. So the involving standards, that means whenever there is the upgradation in the rules, there is a changes in the standards, that must be considered while the preparation of your financial statements. Now next one is, we can say, the complex transactions. Okay. So there are some of, we can say, there are some of the complex transactions. Okay. Sometimes the accountants or the financial experts not understand. Okay. So in which sides the transaction must show. So these are some transactions. So these transactions are also the challenges while we can say the preparation of the financial statements. And last one is the balancing needs. That is, the statement must satisfy the regulatory compliance while remaining the relevant and understandable to diverse uses. Okay. Here is also one example given, that the detailed disclosure required by regulations can create the information overload that obscure truly the material information. That means we can say there are the different regulatory body, regulatory framework. We have to, we can say, follow the balance framework, that is the balancing need of the all the bodies that we are going to must, we can say, follow the balancing. Then and then only, so this is the challenge for the any accountant and the financial expert to follow the balancing from all these, we can say, regulations and the all the standards. Okay. And now we can say, in a traditional approach, in one diagram, you find it out that the guy, we can say, he prepared the financial statements on a paper. Okay, so it is a very hectic process because he have to make all the arrangement, he have to fulfill, we can say, all the adjustment. Okay. So if he miss out any numbers, okay, then there, we can say, mm, then he is not able to balance the financial statements. Okay, then he will not get the exact results. Okay, but in technology based, okay, the sum of, we can say, the softwares like the Tally, okay, use you can make the financial statements very easily. Okay, already the softwares are instruct with the rules and regulations and the standards which are given by the, we can say, the authority or the bodies. Okay, and we will get the financial statements very easily. Okay. So here are some of the numbers which we found, that the why the financial statements are much needed. The 87% the investor thinks that the investors thought that the financial statement gives them the confidence of the invest on the we can say, of the investments. Okay, so they thinks that the high quality financial reporting significantly influence the investment decisions. Okay, so that's why the financial statements are we can say, are that much important. Now the 35% lowers capital cost. Okay, if you are we can say made the good financial statements and analyze that financial statements, that lower your capital cost. Okay, you can reduce the we can say cost of your production. You guys already learned that is the cost sheets in your we can say managerial accounting. In cost sheets you analyze the different types of cost required to we can say made any goods and a service. So what do you find it out, what are the extra cost that you required? Okay, you can minimize that cost. Okay, so all these things you can do from the financial statements. Now the 62% better decisions made taken on based on the financial statements. Okay, so that's why the financial statements are that much important. uh, we can say for any accountant or any financial expert or for any organization that financial statements are that much needed. Okay, so to so your financial reporting must be a good to we can say to straighten your financial reporting. What principles or what steps you follow? Okay, so first one is that is the embrace framework principles. So what are the framework is given by the different bodies, different authorities. So you must follow that principle. So then and then only you can have the good financial reporting. So stay current. That means invest continuously learning about the evolving standards. So what is the we can say the new principles or the standards are given. So you must have the eye on that things and then include in your financial reporting. So leverage technology, use of the technology while we can say the preparation of the financial statements is we can say enhance the efficiency or the quality of your report or quality of your financial statements. Okay, so focus on the users. We can say we see already the different types of the stakeholder who uses the financial statements while we can say the preparation of uh, to we see the different stakeholders who takes the different decision based upon the financial statements. So keep in mind these stakeholders while preparation of your financial statements. Okay, so review regularly your assessment from the perspective of the key stakeholders. These stakeholders like investors, management, debtors, creditors. Okay, we can say the customers. So all these are the main stakeholders of any organizations. So while preparation of the financial statements, you must have to keep all these all these stakeholders in your mind. Okay. Okay, so this is all about the first chapter. Okay, we are going to understand the different accounting standards from the next session. Okay, from the chapter second, we have the different AS, that is the accounting standards rules. Okay, in which we understand the different rules for the different financial statements. Okay, am I audible? Yes, so I think you guys have the next session plan. I think the next session is of the Thorat sir on the subject, I think, advanced financial management, right? Okay, so you can now leave and you can join that session of the advanced financial management, guys. Okay, thank you.
Thank you, sir.